You could lose over $400,000 on a single $50,000 decision. And here's the part that stings. You won't lose it by being reckless. You'll lose it by doing the thing that feels responsible. Right now, gold is everywhere. The ads, the thumbnails, your uncle's group chat, because moving money into gold feels like the smart, protective move when the world feels shaky. Feeling protected and being protected are not the same trade. By the end of this video, you'll know the exact price tag on that feeling, over every time horizon the gold ads never show you. And there's one number waiting near the end that the gold industry would never survive putting on a billboard. Here's what I had to confront, and maybe you do too. If you own gold, or you're thinking about it, you probably don't think of yourself as someone who gambles. You think of yourself as the careful one. Gold isn't just an asset to you, it's proof you're not one of those people who gets burned. There's a name for what's happening here. Emotional accounting. You're not measuring what the money does. You're measuring how the decision feels. Relief goes in the profit column, and the real cost never gets written down anywhere. So I pulled every year of return data from 1928 through 2025, Damodaran's dataset at NYU Stern, stocks, bonds, and gold, side by side, inflation adjusted. I wanted to find out that being careful and being right were the same thing. They're not. Once you see the gap, you can't keep calling this decision careful. Let's look at the numbers. Here's where it stops being a feeling and starts being math. Gold earned some of this moment. It ran hard through 2024 and 2025. Central banks buying, inflation fears real. And when the S&P drops 20% and your gold position just sits there flat, it feels like vindication, like you saw it coming. But that feeling isn't a return. Here's the actual number. The S&P 500 has compounded at roughly 10 to 11% a year. Gold, 4 to 7%. That gap sounds small until you compound it over 30 years. $50,000 in gold 30 years ago is worth about $200,000 today. That same $50,000 in an S&P 500 index fund is worth roughly $550,000. Same money, same 30 years. Over $400,000 gone. Not from a crash, not from bad luck, from choosing the asset that felt safer. Stop there. Don't let that number scroll past. $400,000 is a paid-off house. It's a kid through college. Twice. It's retiring at 60 instead of we'll see. And here's the emotional accounting trick. That loss never shows up anywhere. No red number on a statement, no alert from your broker. Just a smaller life 30 years later that you never connect back to the day you felt smart. And nobody in the financial media ecosystem has much incentive to run this math for you. Compounding is boring, fear is not. This isn't a mistake you made. It's a number an entire industry profits from you never seeing laid out this plainly. It gets worse. Adjust for inflation, and Campbell Harvey at Duke found scenarios where gold's real return goes negative 6% a year for a full decade. Negative. You didn't preserve your purchasing power. You watched it evaporate while feeling protected. That's not a market failing you. That's the cost of a story you'd been telling yourself. People buy gold specifically because they believe it can't crash. In 2013, gold dropped 28% in a single year. Gold mining stocks fell nearly 54%. That's not a bad year. That's stock market crash territory. Inside the asset class you bought to avoid stock market crashes. Sit with that for a second. The escape hatch crashed harder than the thing you were escaping. That's not a fluke. That's proof the safety label is a marketing construct sitting on top of a genuinely volatile asset. And before you think you'll just time around the bad years, even governments can't. The Bank of England sold 400 tons of gold between 1999 and 2002 for about $3.5 billion. Gold that would be worth dramatically more at today's prices, likely tens of billions more. If a central bank with unlimited data and unlimited analysts can't time gold, what exactly is the plan for the rest of us? Maybe the plan was never about timing at all. Maybe it was just believing the safe-looking choice couldn't also be the wrong one. That's emotional accounting again. The Bank of England didn't just lose billions, it felt certain the entire way down. Now, before the gold crowd shows up in the comments, gold isn't worthless. It has a real job. It's just not the one most people hire it for. Gold's value isn't its returns. It's that it tends to zig when stocks zag, not always, but enough. 5 to 10% of your portfolio in gold can cut volatility without gutting your long-term returns. That's the range US Global Investors has recommended for years. And notice, 5 to 10% is never the number in the ad. Read that again. The correct dose is a tenth of your portfolio at most. Everything above that line isn't protection. It's a fee you pay to feel protected. Emotional accounting, with a commission attached. The ad wants 40, 50, 60%, because a bigger allocation means a bigger sale. Correct portfolio construction is boring and modest doesn't move product. Yes, the gold can snap back hard, up 124% in 1993 alone, after 3 straight down years. But that's only happened 3 times in 30 years, and nobody can tell you in advance which 3 of the 30 those are. So the play was never timing it, it's capping it. The enemy isn't gold, it's 40, 50, 60% of your portfolio in it, because an ad made you feel like the market was collapsing, and you needed to prove, to yourself mostly, that you were the responsible one. That's not a strategy. That's the same careful story from earlier, just wearing a bigger position size. So here's what actually matters. 1. Know the real cost. Every dollar you keep in gold instead of an index fund has historically cost you real money. Remember the $400,000 gap on $50,000 over 30 years. That's not opinion. That's the Damodaran dataset back to 1928. 2. Cap your gold allocation at 5 to 10% of your portfolio. That's where it earns its keep, cutting volatility without dragging down your returns. Above 10%, you're paying a premium for fear. 3. Notice when you're being sold to. Gold advertising spikes exactly when you're most anxious. Downturns, inflation scares, election years. That's not a coincidence. Your anxiety is their conversion event. 4. Zoom out and understand what's actually happening to your generation. If you're 25 to 45, you came up through market crashes in a housing market that priced you out of the asset class your parents built wealth on. None of that is your fault, but it is the reason gold ads land so effectively on you, specifically. You were the target market before you ever saw the ad. And that's the real skill hiding underneath this whole video, catching emotional accounting in the act. Because gold is just today's example. The same trap sells oversized cash cushions, overpriced annuities, paying off a 3% mortgage while inflation runs hotter than that. Different products. Same accounting error, the relief is real, so you assume the math must be too. So here's the trade you're actually being asked to make. Not gold versus stocks, it's do you want to feel careful or do you want to actually be careful? Those used to feel like the same decision. They're not. The version of you that gets to 30 years from now with real money isn't the one who bought the thing that felt safest in the moment. It's the one who was willing to look boring for 3 decades while it compounded. If this changed how you think about gold, hit subscribe. Even if it just made you question the last gold ad you saw, or the story you've been telling yourself about being the careful one. Because once you can name emotional accounting, you start catching it everywhere. That's the whole job, honestly. I run these numbers because the assets people trust without question, including things I believed myself, are usually the ones nobody's bothered to fact-check. Speaking of which, the 10-year return gap between SpaceX and just sitting in cash isn't a percentage. It's a specific dollar number that's going to make this gold gap look small. That's next.